Hello and welcome to today's primetime session on markets and carbon trading. My name is Camilla Macpherson and I'm Head of Secretariat. This session is being recorded and will be distributed later. Attendees are muted and have their video turned off. If you have a question or comment, please use the Q&A function to get in touch. It can be helpful to include your name and affiliation. I'd like to thank FTI Consulting, McCann Fitzgerald and Travis Smith for sponsoring this series of Prime Time. And thank you also to Lexis for supporting Prime Time and assisting with promotion. Let me now introduce our moderator for today's session. Dr. Peter Werner is a senior counsel at ISDA. He's a global lead on financial law reform and a representative on law reform matters to a number of international organizations. He's also responsible for ISDA's documentation projects in energy and commodities, including documentation for environmental trading, such as emissions allowances and renewable energy certificates. He's part of the IIF task force on scaling voluntary carbon markets in the legal work stream, and you'll be hearing more about the task force later in this session. Peter, let me now hand over to you.
Thank you, Camilla. I'm glad to be the moderator for this session. Welcome, everyone. As companies commit to reducing emissions and investors demand clear transition plans, a well-functioning voluntary carbon market will be critical to reaching net zero. How can this be achieved? Our panelists will provide their views on this. In fact, today is a good point in time to run this webinar, as in November, the COP26 event is scheduled to take place here in the UK. Major topics under the Paris Agreement are on the agenda, of course, for this event. Also, it so happens that around 2 weeks ago, we saw the announcement by the TSVCM on their new governance body over the voluntary carbon markets. At the current session of the UN General Assembly, climate change is the #1 topic, as well, as you may have seen in the press reports. We are delighted to be joined by 3 expert speakers to provide their perspectives on the carbon markets today. I'm going to introduce them briefly. We have Annette Nazareth, who currently serves as operating lead of the Task Force on Scaling Voluntary Carbon Markets, TSVCM. She previously headed the trading and markets practice within Davis Polk Wardwell's Financial Institutions Group. Annette was a key player in financial services regulation for nearly a decade, having served as a commissioner of the US Securities and Exchange Commission and as a director of the Division of Trading and Markets. Welcome, Annette. We have Michael Azlen here, who's a senior investment professional with 25 years of industry experience, including the founding, growth, and sale of a regulated investment management business. Michael is now focused on research and investment strategies that will have a positive impact on climate change. Mike has been a guest lecturer on the master's degree program at London Business School for 15 years and now teaches a new segment on the impact of climate change on the investment management industry. Finally, we have Ian Cuillerier. He's a partner in the New York office of White & Case. He's a member of the firm's Global Derivatives Group and the firm's Canada Practice Group. Ian has more than 2 decades of experience advising on a wide range of derivatives and structured finance matters. He also possesses notable regulatory experience. As part of his focus on commodity transactions, he regularly counsels market participants in the financing of renewable energy projects and emissions trading. So the running order we have in mind for today is that each of our panelists will give their initial take for a couple of minutes on the topic, and then we'll follow up with questions. Mike is going to go first, and then followed by Annette and Ian. And let's hand over to Mike, perhaps, and he will give an overview on the carbon markets and how they function. And Mike has prepared some slides for this purpose as well. Mike, maybe now is a good time to share the screen.
Excellent. Thank you very much, Peter. And I also wanted to thank P.R.I.M.E Finance for inviting me to present today on this very topical subject of carbon markets. I only have 7 minutes, so I want to be very brief to cover a little bit about the compliance carbon markets. But before doing that, a quick reminder on the challenge that is before all of us. The blue line represents historic emissions, and then you can see the current Paris Agreement pledges resulting in approximately 3 degrees of warming. So we have much more work to do in terms of improving the Paris Agreement pledges, and we're far, far away from the 1.5 and 2 degree pathways. So it's just a reminder that this is a very, very big challenge, and literally every aspect of our lives must change. When you study, as I did at the LSE, the policy measures across the world that have been enacted to impact and bend the emissions curve downward, really nothing has worked. But one policy that has worked is when we place a price on emitting carbon. Carbon pricing is one of the most successful strategies to get companies, governments, and individuals to change behavior and look for low carbon alternatives. Today, we have over 60 either carbon taxes or cap and trade markets, but they only cover about 24% of total emissions on the planet. The very positive development this year was the launch a few months ago of the Chinese national carbon market, covering more than 5 billion tons of annual emissions. As you know, a carbon market caps the amount of emissions and lowers that each year by between 2 and 4%. So one interesting observation when we talk about the scale of impact, if China lowers emissions by 2%, that's 100 million metric tons per year. That's the entire emissions of the United Kingdom in an annual reduction. So scale is a very, very important part. And therefore, I want to spend a moment describing how a compliance carbon market works. So today, there's voluntary carbon and compliance carbon. They're very different, although there are some links between them. The key differences are the compliance markets are government mandated and regulated. They're very liquid and very large. So last year, the compliance markets traded about 300 billion US dollars. The voluntary market, which I'm sure Annette will talk, traded about 300 million. So there's a 1,000-fold difference between the size of these two markets. And the final point is on liquidity. The compliance markets are very liquid. There's exchange traded instruments, and the voluntary market is today becoming more liquid, but still is a shadow of that. And we need both to achieve our climate change objectives. In the compliance market, it's mandatory. So if you emit in Europe more than 25,000 metric tons, you are included by the government. You cannot opt out. Carbon allowances are then allocated to you, or you buy them at auction. And those allowances permit you to emit a ton of CO2. And this again is in nomenclature. We talk about carbon allowances in the compliance market, and we talk about carbon offsets or carbon credits in the voluntary market. Entities are audited very tightly, and they must submit allowance certificates that equal their prior year emissions. If they don't, the penalties are severe. In Europe, more than 100 euros per ton penalty, and we have 99.9% compliance. So everyone complies. Entities can buy and sell carbon in the market. That sets a price for carbon. Carbon today in the compliance market is trading $2 to $3 billion every day. So it's a very liquid market. So a very accurate price signal is going out to those companies. The total supply is capped. So in Europe, the supply is capped at around 1.5 billion tons, and that cap is lowered every year. And this gives us the environmental certainty we want around a climate policy, where we have a certainty that emissions will indeed fall year on year. And trading of carbon between the entities, this liquidity and price discovery means that the emission reductions which must take place in the compliance market. They must, because there's less permits available every year, but it means that those emissions reductions are using the power of the invisible hand of the market to allocate the allowance certificates such that the lowest cost company is indeed the company who abates their emissions. And that's very important. This liquid market allows companies to hedge, and indeed many big companies will hedge their carbon obligations 2 and 3 years out forward. And the auction revenues that governments take in are targeted at energy efficiency and low carbon initiatives. So it's another nice byproduct of an emission trading system. In Europe, emissions have declined by 1 billion metric tons per year since the carbon market came in 2005. Now, of course, there's been many reasons for this decline, not only the carbon market, but the carbon price signal has been a very important part of that success. And that success has promulgated many more countries to launch carbon markets. Today, there's about 10 carbon markets around the world, but there's another dozen countries who are launching their own carbon market. Only last week, Malaysia announced they're launching their own national carbon market. At Carbon Cap, what we have done is build a liquid impact fund that invests in these liquid carbon markets. We believe carbon prices need to rise substantially to meet the Paris Agreement objectives. And therefore, we have a fund that has these dual objectives of targeting a strong return for the investor, while at the same time having a direct impact on climate change by lowering emissions. We've done a CFA-sponsored case study on carbon as a liquid investment, and it's performed very well over the last 7 years, rising by approximately 20% per year. We believe that this type of growth could continue for another decade. When one looks at the Paris Agreement objectives and calculates how high would the carbon price need to rise to provide that crucial stimulus to meet the Paris Agreement thresholds, the answer, I've listed 4 very well-respected studies here, is about $100 per ton. And today in our portfolio, the carbon price is about $30 a ton. So we do believe there are excellent opportunities. I think I've used up most of my time, but I'll just conclude by saying that the fund has grown in the last year and a half by about 30% total return, and we think there are excellent prospects. 20% of the performance fees of the fund are used to buy compliance carbon and permanently retire that carbon. And we believe that's the highest quality solution to remove emissions. And so I'll conclude there. I'm sure there will be many interesting questions, but I look forward to the presentations from the other panelists. Thank you very much.
Thank you, Mike. Thanks for setting the scene. And we've already heard then, thanks to you, the big distinction between compliance emission market and voluntary markets. And one main player, key player in the current discussions about voluntary markets is Annette, of course. So Annette, she's going to give us an update on some background on what she's been doing there in TSVCM. Annette, you have the floor.
Well, thank you so much, Peter, and thanks for this opportunity to talk about the Task Force on Scaling Voluntary Carbon Markets. It's been a big part of my life for a year now. It was formed last September of 2020. The task force was initiated by Mark Carney, who many of you will know is the UN Special Envoy for Climate Action and Finance. The task force was sponsored by the IIF. Tim Adams is the president, and the chairman is Bill Winters, who, as many of you know, is the CEO of Standard Chartered. And I've been the operating lead. This task force brought together over 450 individuals and 250 institutions from across the value chain. Huge diversity, geographic diversity, diversity between, buy side, sell side, market infrastructure providers, exchanges, clearinghouses, and the like, NGOs, investor alliances. So we had a very broad global presence and a deep commitment to coming up really with a recommended actions and a template for scaling the voluntary carbon markets, which, as Mike did a great job of distinguishing the voluntary markets from the compliance markets. So why was it so important for the voluntary markets? I mean, frankly, I think to meet the 1.5 degrees Celsius pathway of the Paris Agreement, we're going to have voluntary markets complement the compliance markets. And fortunately, we have a broad range of market participants now who are committed to reducing their carbon emissions immediately, which is going to be absolutely necessary. But why do we need offsets? I mean, frankly, the first priority should be for everyone to reduce their emissions. But, you know, as we all know, some organizations and sectors can't reduce fast enough. And what they would like to do and are committed to do is to participate in the voluntary carbon market so that they can compensate for the remaining emissions, what we call that last mile of getting to net zero as quickly as possible by financing the reduction of emissions by other sources or the removal of greenhouse gases from the atmosphere. And one way to do that is also to finance technology projects. So, you know, as Mike alluded, you know, we really do have a big gap between where we need to be currently and where we are. And we think it's imperative that the carbon offset market, frankly, increase in size by 15 times where it is now by 2030 to support the 1.5 degree pathway. And so we're very committed to do, you know, what is necessary to get there. So, and unlike the compliance markets that Mike talked about, the voluntary markets are not as liquid, not as transparent. They're very fragmented. They're opaque. They lack liquidity. They lack standardization. As we all know, those of us who have spent a lot of our careers on market structure, you know, what you want to have a vibrant market is a deep, liquid, transparent market. We don't have that. We also don't have enough in the way of risk management tools, including, you know, forward contracts to manage price risk in the voluntary markets. And frankly, low prices lead to, in the carbon voluntary markets, lead to purchasers being worried about the quality. And also, as we all know, there have been concerns about greenwashing, which is something that absolutely has to be addressed. So this task force was put together to establish a blueprint on building a voluntary carbon market. And there were, as you can imagine, action points that were identified to build those markets. And then from there, we focused on doing sort of a deeper dive into those areas where we thought we could make the greatest impact and where we thought other international groups could also, you know, engage in parts of this effort so that together we could make substantial progress. So I would say one of the keys that we have focused on is establishing an exchange-traded core carbon reference contract. And we have the building block of what we're doing is establishing core carbon principles, which is a high-level set of principles that address the threshold quality criteria that an offset must adhere to. And we've also recommended a taxonomy for additional attributes that many investors would be interested in having as well. And so, and we've also focused obviously on, you know, other infrastructure building blocks, whether it be, you know, exchanges, clearinghouses, registries. The great part of that is that, needless to say, there is a huge interest on the part of infrastructure providers to be involved in this effort. So it takes very little from us other than, again, establishing the core principles so that those infrastructure providers can adopt them and create trading platforms and registries and the like to trade these products. So with that, I'll sort of end and perhaps later talk a bit about the next steps where we are now. But I would say that after a year-long effort, we're very pleased with where we are. We're ready to implement. We have formed a governance body that I'll talk about a bit later, and we're ready to go because we think that 2022 needs to be a very active year for us to start rolling out core carbon principles and seeing a scaling up of trading of the voluntary carbon offset market. Thank you.
Thanks, Annette. Great initiative. Excellent. Ian, could you give us a little bit of an insight from the transactional perspective, some of the legal issues that you have seen arising in these types of transactions, in emissions, etc.?
Sure. If I go back to the initial threshold question, reaching net zero and how can it be achieved, Mike and Annette certainly did a fantastic job of laying the foundation. I would just reiterate a couple of points. Reduction being important, but without reduction, we don't have that last mile is important, and for that markets are essential. I would see a renewable energy being a big factor in that: wind, solar, batteries, and electricity being at the heart of energy as we know it. When I think about markets, finding principle I see are effectively the conversion of the right to pollute, or a measure conversion of a measure of an emissions reduction into a tradable unit. And that tradable unit really is one that needs to be fungible, needs to come from, and would inevitably come from, many sources. So the task is, in the construct of a market, thinking about what needs to be done to establish that conversion and have it be efficient, effective. And so markets need to be really well integrated, transparent, and have a considerable amount of accountability. Without it, you don't have credibility, and credibility through and through is important. Without it, you don't have buy-in, you don't have engagement. And all of these elements are key to achieving net zero. On the methods employed, and perhaps I go back to what Mike said, pricing carbon, in my mind, and having a price in the US and the largest market is essential. The current patchwork, I'll call it a patchwork, is very helpful, but I do see there is disconnection in one sense. The compliance markets to the voluntary markets, getting those integrated will be important. Seeing all of these elements driving towards net zero. The last part of that, perhaps to the integration, having governments establish cap and trade models and the framework, as opposed to carbon taxes, so that the price of carbon within the US can be established more readily across the US, as opposed to in specific markets. Would be important in establishing the objectives, or reaching the objectives we're seeking. As to the transactions, yes, they are liquid in the compliance markets. I do see them be brokered transactions. I see them in the ISDA annexes that are out there, and perhaps a word on them. The ISDA has produced a US, a UK, and a ISDA annex for trading emissions, and I know that they're used in Europe. In the US, I do, however, see more brokered transactions, more bespoke transactions, more long-form conforms and the like. So there's lack of uniformity that is perhaps present, but they are buy and sale transactions, purchase and sale transactions. More spot transactions is one feature that I do see in the market here. So there is some lack of uniformity in the compliance in the voluntary market. Sorry, that is very bespoke, as Annette was speaking to. So purchase and sale agreements, perhaps on larger scale, where you'll have a market participant from a developed market look to a developer or a project sponsor in a developing world. I think of carbon sinks or forests and yes, carbon sinks in a natural state and looking to preserve them. But on the back of that, you have these transactions where offtake arrangements for the carbon credits from those carbon sinks can be entered into, where the entity in the developed market purchases over a long term the carbon credits, the offsets from that project. Certainly see those. We see in the context of these initiatives and investments a fair level of diligence that needs to go into establishing the right to actually sell that carbon offset, and informing our clients of what it means to actually trade in voluntary markets and how the voluntary markets react or interact or don't interact with the compliance market. So the level of information, the types of questions people are asking themselves right now, and what I'd say globally is something of a fragmented market. People are coming to this market looking for basic threshold questions to be answered. And the transactions that happen within that are something of a patchwork. I'll stop there and turn it back over to you, Peter.
Thank you, Ian. I was trying to unmute myself. Very interesting indeed. And just to echo what you've been saying here at ISDA level, we've been receiving lots of queries as to how one can look at the documentation solution, any documentation solutions for trading in voluntary markets. So that's also a follow-up from the discussions that have been taking place in TSVCM. So thanks for this initial round of comments from all three of our speakers. We have a couple of questions that we wanted to run by the speakers. And maybe I can start with one for Mike, based on his presentation. Mike, how should an investor think about investing in carbon when they're looking at their overall portfolio?
Yes, well, that's a very good question. We've done a lot of work on looking at how carbon performs as an investment compared to other typical asset classes an investor would hold, such as an equity portfolio or bond portfolio or real estate. One of the attractive features of carbon thus far, anyway, very difficult to predict the future, but in the past, carbon has shown effectively zero correlation to these other asset classes. And in fact, in one of the things that I teach to the graduate students at London Business School is about portfolio construction. And that is indeed one of the things we seek in building a diversified portfolio is to find asset classes that have first a positive expected rate of return, so something that you think is going to appreciate in value. But then if you can combine that with something that will have a low correlation to the other investments that are in your portfolio, that's then very beneficial. So we believe that carbon will become a mainstream asset class. As I said, it's trading 2 or 3 billion a day now today. We think that'll approach 5 to 10 billion per day in trading once the Chinese, Korean, and Mexican markets are all fully up to speed. So we're really at the early stages in the development of the asset class, but certainly we believe it makes sense in an investor's portfolio.
Thanks, Mike. Looking at the questions. Here's one for Annette. Could you describe the work of the task force and next steps, perhaps?
Sure, thank you. And you know, sort of teeing off some of what Ian said. I mean, it's I think he described very well sort of where we are currently, and even described, you know, the fragmentation from a practitioner's standpoint in terms of documentation and the like, where, you know, if you're trying to scale up a market 15 to 30 times where we are now, you can't have these individually negotiated bespoke contracts as representative of the whole market. The task force certainly can't mandate exchange trading through standardized contracts, but we can certainly create an environment where that's what's being offered. And it just seems to me that liquidity begets liquidity. Once you start having standardized contracts with sort of set legal principles that trade on organized markets that bring buyers and sellers together, you're going to see scaling. And so that's an important next step for us. How we get there, as I said earlier, is partly through the establishment of core carbon principles. We need a criteria for carbon integrity. The other thing that Ian talked about that really resonated with me was talking about how today you have to do diligence. There's a lot of diligence involved, right? Whereas, you know, and that's a friction. I mean, when you trade a stock on the New York Stock Exchange, you don't have to go and diligence your counterparty. And, you know, obviously, if you have to do that with every transaction, you're not going to have as many transactions. And the only people who are going to be involved in that market are going to be the most sophisticated parties. And that's frankly what we see today. The most sophisticated parties that are the ones that are engaged in the voluntary markets because they have staffs of people who know how to negotiate ISDAs, who know how to do the diligence, who, you know, can invest the time, but that's not consistent with our goals. So, you know, frankly, taking the discussion forward from where I left off, I mean, after we, you know, came up with a blueprint for the markets, we then in July published a roadmap that talked about how are we going to take this forward. And frankly, I want to thank Peter at ISDA for providing some advice to us. And ISDA was a great example of what we look to. How do we create an entity, an ongoing entity? Because the task force is of, you know, temporary duration, right? We have to hand this off now to a governance body that is going to have its own, you know, independent structure and ongoing life, and it will be tasked with, you know, creating the CCPs, setting the legal standards, ensuring integrity in the markets, and so that governance body is what we have. You know, that's the real progress that we made since July. We have focused on establishing and setting up the governance body, which was announced last week. We're very proud of it. It has a majority of independent people on the governing board. We're going to be adding 3 representatives of Indigenous peoples and local communities because we felt that, notwithstanding the broad diversity across continents and experiences and expertise, we wanted to make sure that we were representing that group as well, and felt they were underrepresented on the board that we're establishing. We have elected market representatives on the board, but they are in a minority, only 3 out of the 22 members of the board. And, you know, we've got a number of founding sponsors, a senior advisory council, which has distinguished leaders from a broad range of backgrounds who will be advising the board. And most importantly, we have an expert panel, which is going to have 4 expert leaders from across the globe who will advise on the CCPs, advise the board, and provide their expertise in that area. And finally, to make the engine run, the engine room will be provided by an executive secretariat of 4 sort of leading organizations that will provide expertise in keeping us operating as a body. So, I mean, this has been, as you can imagine, a really quite substantial effort. But I'm very optimistic now that we've gotten, you know, to this point that within the next 12 to 18 months, we're going to see, you know, significant progress.
Thanks, Annette. I was going to add the question as to, you know, what the timeline is, but you just said it, 12 to 18 months. So this is a Herculean task. So, and this is very serious. So all market participants are very keen on being involved here. So good luck with that. That's definitely very relevant work. Ian, we've got a legal question here. What are some of the threshold legal issues present in carbon markets as they stand today? That's an interesting question also from an ISDA perspective. Do you have any views on that?
So sure, thank you. And I guess I could look at it from the documentation perspective, and as well, there are some threshold issues that we engage in. Just a at the documentation phase. So that may be a little bit more granular, but I'll come back to the more general in a moment. So some of the issues that we do face, particularly in the voluntary market, title and ownership issues, and you can get representations around that, and indemnifications are included in documentation to address that, making sure that in the primary market, sellers don't double count. These are some of the issues, I should say, that the task force in their report in July did outline a number of these, and our experience comports with this. So that would be a good reference to part of this question as well. But failures to deliver, force majeure are issues, and how you deal with that and what you negotiate within your contract. As you're moving some of these credits into compliance markets, where one of the parties does have a compliance obligation, compensation for failures or violations of applicable law or failures of breach and representations and warranties is an issue that we negotiate as well. Abandonment of scheme, and some of these, and we may end up seeing that as we transition forward, but abandonment of scheme is a feature of the ISDA annexes that I mentioned earlier. The reality is that the very scheme in connection with which you're executing your trade might cease to exist. That's maybe in some markets less of a concern, but as we move forward and how we integrate the two, perhaps some elements of that chain are not well established, and we might think about how in the documentation one needs to reverse course if that ever happens. I find the legal classification of the credits themselves as being an interesting question. The EU did commission a study and report in 2018 around, at the EU level, how one is to consider the legal nature of these credits and of the allowances, sorry, at the EU level. And the report goes on to explain that this was a matter of each of the member states to establish. They looked at 5 member states, and each of the member states went about the legal classification exercise differently. And so you end up with variability there. And then none of the the member states actually within their local laws define the legal nature of the allowances, which also was interesting. I relate to the US experience. California, as part of its law, specifically says that the allowances are not property. I wasn't there at the time, or perhaps I didn't focus on it, but I can surmise one of the reasons why they did that was over concerns perhaps around if ever the markets dropped in prices, they need to intervene quickly. An over allocation of sorts may have resulted or caused that depression in prices, and they might wish to cancel some of the allowances. And if you speak under the US Constitution of a government intervening to cancel property of another, you're thinking of compensation. So you don't want, if the government didn't want to do that, the administrators of the scheme didn't want to be compensating private individuals in the context, one path would be to say the allowances themselves are not property. But elsewhere in the United States, courts have suggested or have said that allowances or offsets are actually property. And you end up with interesting conflict of law questions when you get offsets from one state in the US into the California market, for example. And also, if you're financing these and you don't know the actual legal nature, how does one take a security interest in them? That's a threshold legal issue. Change in law risk as the market's developing, that's always a concern. In bespoke contracts, whether you have safe harbor, the benefits of a safe harbor under an insolvency code that may be applicable or would be applicable is an important question, is a threshold question. And then on the diligence that Annette did actually focus on as well, there are some interesting issues and questions. So domestic law of developing markets do need to link their domestic projects to the domestic scheme, and it needs to be done in a way that is credible. That is a threshold question. I focus on the national forest tenure systems of many countries, and they vary from country to country. So you need to be able to establish control on the land or control in the activity that gives one the rights to actually transact in the carbon in the carbon itself. And not all countries have a clear delineation of who owns the forest. If they're owned by the governments, and that's clear, well, then carbon rights can be granted in the land through concessions or licenses. There's more certainty in those contexts. But in countries where you have diverse forest ownership, for example, and weak land rights, and you combine the two, then you get a significant amount of uncertainty, and that is another threshold question. So these are all issues of diligence, and as the markets develop, where we get credible, and the P.R.I.M.E Foundation becomes credible, these are all key elements to resolve as we're looking to build out and scale the markets.
Thanks, Ian. Thanks also for reiterating the distinctions between primary and secondary markets, and also highlighting the fact that a lot of these activities relevant to trading take place in the global south. And there's an additional layer of need for legal certainty here. So interesting to hear from you that all of these points that you have seen, they also echo with what we've seen here at ISDA and are trying to address going forward to an extent. So that's very helpful. There is a question that popped up in the chat just now that's directed at all panelists. So maybe I can just bring that one up since we're at it here. Could the panel elaborate on the potential correlation or interaction with commodities markets? I found that quite interesting. So any views? I don't know, Mike, perhaps sounds like one for you.
Yeah, we've done all that analysis, and again, I can only speak to the compliance carbon markets, for which we have approximately a 15-year history. And the two interesting areas, I've already mentioned the lack of correlation between carbon and mainstream asset classes such as equity, bonds, and real estate. But carbon has also shown a very low, effectively a zero correlation to individual commodities and to broad commodity indices. However, one caveat I did want to add is that in some carbon markets, such as the California carbon market, the price floor and the price ceiling in that market are connected to inflation, to the US Consumer Price Index. And one of the interesting things is looking at carbon as an inflation hedge. And several of our current investors in the fund, in fact, that's part of the driver for that reason. And you can understand the mechanism there, not only with the carbon pricing corridor being linked to inflation each year, it goes up at 5 to 7% plus inflation. But the other interesting aspect is, of course, as carbon price rises, that price rise gets impounded into the price of the underlying goods or services as they effectively absorb the carbon price, and that may be a second order effect of inflation. So it's quite an interesting area, and again, that CFA case study with all that analysis is available on the Carbon Cap website.
Mm-hmm. Thanks, Mike. Going on continuing with the questions, we have a couple of more here, and I see some more coming in.
Sorry,
Ian,
one thing I was just going to add to the correlation, and perhaps it's a mention of ISDA's work around correlation. In July, ISDA did publish a white paper on the treatment of carbon offsets in the context of the fundamental review of the trading book within the framework of Basel. Yes, yep. And there, just in terms of, now this isn't comparing, and I recognize the question is slightly different, but this isn't comparing carbon to other commodities, but carbon in and of itself, and whether it's receiving the right risk weighting and capital treatment. And effectively, through empirical evidence and study, they've done a good job outlining how it is not correctly viewed, and hopefully they're engaged in proper discussions. It seems to be the case, but discussions with policymakers and representatives that have the ability to change matters in this respect, to adjust the risk weighting and the capital treatment there. Just the correlation of them, the spot to the forward market seem to be much more highly correlated than other commodities. And so that needs to be refined, and the effect of that would be to allow greater participation through liquidity providers and dealers, not having to deal with that excess capital in those transactions.
Thanks, Ian. Any additional comments on this topic before I move on? A question here for Annette, which goes as follows. What are the challenges to standing up a transparent, liquid, and robust voluntary carbon market?
Well, I think we've been addressing these challenges for the last year and will continue to do so. I thought Ian raised some legitimate and interesting issues around cross-border legal issues. As you know, Peter, we learned quite a bit from you and your colleagues at ISDA about the legal opinions that you get annually, for legal certainty in a number of areas. That obviously is important. But the challenge and the opportunity at the same time is to show that we have a governance body that is committed to create carbon markets with great integrity and that foster confidence and therefore foster greater trading in that market. And that's where I think we believe we're very well set up. I mean, we've spent so much time on the governance structure, on ensuring that we have people of the highest integrity, majority, more than majority, independent directors, experts from across the globe, who bring that expertise for us to, settle on the CCPs, establish legal standards, and the like. So as I said, it's a challenge, but it's also an opportunity because I think we're well positioned to address the issues.
Yeah, absolutely. Thanks for that, Annette. Yes, the confidence in the market, and it's a very impressive proposition that TSVCM has come up with. Just on the point of the legal issues, yes, in light of issues like the legal opinions that industry bodies provide, the issues that Ian touched on deserve further elaboration, and for what it's worth, we have we are preparing at the moment a white paper on the legal nature of carbon credits in order to help that discussion go forward, because as pointed out by Ian, even at EU level there has never been any proper decision on what these emissions allowances are, and we have case law, of course, here and there, but we need more certainty here, and in particular across the globe, particularly also in the area of voluntary credits. We may have some guidance on compliance markets, but not really on around voluntary credits. So more fun to come there for lawyers. There's a follow-up question on the legal side. Ian, if I can ambush you with that one. It says, it's from John Williams. It says, Ian, do you think there's a potential role for some sort of industry standard diligence, or is there too much noise created by local law deviations and other local land law matters? Obviously, please, everybody feel free to chime in here. Ian, sorry for putting you on the spot.
No trouble. Thank you, John, for the question. And as I read it, I do think that Annette could speak to some of that, based on her experience and discussions on that at the task force as well. Is there some role for an industry standard diligence? I do think that in scaling the markets initially, there are some fundamental threshold questions that could benefit from a comprehensive exercise, one that would be open to many market participants collectively. So I do think that there's some benefit, there would be benefit to having a collective engagement around these threshold questions, so we're not all individually asking and answering these similar questions, because as Annette did say, they are fundamental to the construct of a voluntary market. So I do think that there's some benefit to it. Noise, yes, I think there would be noise, but I just think it just goes to the size of the project and the task. But you could define the scope to be the ones that are most pressing, and I think you can handle the noise by structuring an approach to a diligence exercise that is cognizant of the potential deviations and that the project be too big, so you could scale the project to use the word that around the diligence exercise. Annette, I don't know if you had anything else.
Yeah, no, I think that's really helpful. Look, I think the CCPs have to have almost embedded in them, right? This, you know, these concepts, and the governing body is going to oversee the standard setting organizations on adherence to the CCPs. And so I think, you know, as part of this process, we want to be sure that those standard setting bodies have principles and standards that relate to diligence, because obviously the only way this market is going to succeed is if there is you know, integrity in the markets, and that we can have confidence in the contracts themselves.
Great, thank you. There's a question here to Mike, which I just in the chat, which asks for, it's from Sharon Brown-Roska, which asks for, who asks for the link to the carbon cap case study that you mentioned earlier in the slides. I think I can't remember if there was a link in there, but I'm sure we can provide that link subsequently. The same goes for the ISDA white paper that Ian mentioned. We can make that link available via the Secretariat, no doubt, afterwards, if we can't send it around now. Mike, can I, here's another one. Can I get you to look at this one? Do you see owning carbon as a green or /ESG asset? Is that
so generally speaking, owning carbon is seen as green. As I mentioned, it also may provide not only an inflation hedge, but a hedge against other climate change related exposures in the rest of your portfolio. To give you a good example there, in the event of a rising carbon price that makes the cost of reducing CO2 emissions more expensive for a certain industry, whether it be steel, cement, chemicals, these are the big emitting industries, you can imagine that the carbon price going up could impact gross margins and profitability going down in those industries, and therefore owning carbon may be a hedge against some of the climate change related regulatory risk that is present in a diversified equity or bond portfolio. And therefore, I think that carbon as generally as an investment or as an asset class, it is considered to be, by buying and holding the carbon as we do in our fund, we're tightening the supply. We're taking supply out of the market, albeit a very tiny amount. The market is, you know, many thousands of times bigger than us. However, it's nice knowing that those carbon permits have been removed for a period of time from the market. And of course, with our performance fee contribution, we permanently cancel those, so they can never be back into the market, and that carbon dioxide cannot be released. So it really depends on what approach you want to take with carbon. What's interesting is to see a number of companies now are beginning to launch initiatives whereby offering a corporate net zero offsetter the opportunity to do that instead of in the voluntary market, actually to do it in the compliance carbon market, which really hasn't existed up until now. So I'm really watching those initiatives quite closely. That could be quite a game changer.
Thank you, Mike. Talk about corporates. I don't know, Ian, if you mentioned a couple of legal issues earlier, but here's a query that's more general. I don't know if you would like to comment on this. What risks do you see for market participants, for example, corporates, wanting to achieve net zero or start trading in carbon markets? Anything else that people need to be aware of?
Yeah, a couple do come to mind. I think that from a securities perspective, to the extent these large corporates are public issuers, there is disclosure risk around what it is they would be saying on their carbon footprint to investors, and so that does carry with it a significant amount of risk in making sure that it's properly addressed with attention in all public disclosures of companies would be I think a risk that market participants may be facing from that perspective. There is understanding the regulatory risk around trading in these assets. I think it's an asset class just as any other inside that would be subject to the CFTC's jurisdiction, and And so understanding the contours of that jurisdiction and their oversight is important. And I'm speaking from the US experience in the CFTC. Likewise for European regulators. And in the voluntary market, we did speak to how more thinly traded they are. There is concern in depending on how the linkage between the voluntary markets and the compliance markets and how actual futures markets play their role within those that linkage and within that going forward. I guess there is risk around market manipulation and disruptive trading practices, which I always view as perhaps more present in more thinly traded markets. Now, the compliance markets are large and such that it may be less of a concern, but I do worry about this asset class vis-a-vis others. The CFTC doesn't have jurisdiction in cash markets, but to the extent there is fraud and manipulative behavior in cash markets that impact markets that they do regulate, then they do have jurisdiction. So those are all things in terms of risks to market participants from a legal perspective that I think market participants need to be mindful of.
Could I just jump in there, because I think this issue of carbon risk is a very, very relevant topic today. I can't speak for the other panelists, but I certainly am overwhelmed by the number of voluntary carbon projects that come into my inbox seeking funding to develop a carbon offset or a carbon credit of some type, often from the emerging market countries, and often purporting to have some type of high quality carbon offset that has yet to be gained any standardization at all. And my real risk is really buyer beware here. I think that inevitably the rush here means that millions of dollars are going to be invested in the development of voluntary carbon projects, and unfortunately many of those will in fact not come to certification, and investors will indeed suffer large losses. So I really would encourage listeners to be very careful about the various products that are out there in the voluntary market. As we mentioned, it is very fragmented and largely unregulated, and therefore you really have to really look at the higher quality end of the market. And I guess the final thing is really look at the price that you're going to pay for something. If you're looking at paying $2 or $3 a ton for CO2, I think the price tells you a great deal about what you're getting and what's behind it.
So Peter, could I address that? I think those comments were all incredibly helpful. I like to think that help is on the way, that with the efforts of the task force and the ongoing governance body, that we will see more transparent markets with greater integrity. I agree that the situation that Mike described is a big concern now. And I was also, something that Ian said resonated with me as well. He talked about public companies and their obligations. I've been saying for a year now that, public companies want to be part of the solution here. A lot of this is because they've got shareholders who are urging them to commit to net zero, urging them to engage in these markets. But those companies and their boards also have fiduciary duties, and they want to be sure that if they're investing corporate assets, that they're doing it in assets that are of high integrity, that there's not greenwashing, that there's not all sorts of problems with the underlying projects. So that's the issue that we need to address, and I think that is spot on what we're trying to focus on with the task force.
Great, thank you very much. We have reached time. Thank you to both panelists and also the attendees for attendance. As you can see, this topic is a very interesting one. There's plenty of issues that Prime Finance as a body could also take up going forward. So we hopefully this has encouraged the Secretariat to keep looking at this topic, and maybe we'll have another panel session on this in the not too distant future. So this was the final event in Series 4 of Prime Time. To find out about future events, have a look at the Prime Finance website, please, and or connect to Prime Finance via LinkedIn. We would like to thank FTI Consulting, McCann Fitzgerald, and Travis Smith for sponsoring this series of Prime Time. If you're interested in sponsoring a future event, please get in touch with the Secretariat. We would also like to thank Lexis for their support. And then finally, Prime Finance accepts donations through Friends of Prime to support its work. If you would like to make a donation or find out more, please contact the Secretariat using the details showing in the chat box, which you can see now. So again, thank you very much to our panelists for taking the time, and also to our attendees for watching this, and have a good rest of the day. Thank you very much. Bye-bye.